exceptions. Distributions of partnership income to partners in the form of cash are generally not a taxable event to either the partnership or the partners. True or false? Generally, with limited exceptions, okay, we're allowing for exceptions, like distributions in excess of basis, for example. We're not talking about that. Distributions of partnership interest income to partners in the form of cash are generally not a taxable event. Is that true or false?
False.
Okay, so you're saying that the taxable event occurs when properties or cash is distributed to the partner, as opposed to when the partnership earns the income at the end of the year. In other words, the partner doesn't get taxed until they receive something? Or are they taxed on their distributive share, whether it's distributed to them or not?
When they receive something.
Okay. Do you want to try that one?
Yeah, the last part they said, the partner gets taxed when received.
When does the taxable event occur to the partner? When the partnership earns the income? Or when the partnership distributes the profits to the partner?
When the partnership distributes the profits to the partner. Is the
Really?
partnership
No.
When the partnership.
Alright,
When the
I'm
partnership-
so glad I asked this guy. There's a tremendous misunderstanding here. You guys are thinking corporate tax. When you have a C corporation and the corporation distributes a dividend, if the corporation never makes any distributions to the shareholders, there's no taxable event to the shareholder in the C corp. We're not talking about S not. But S corps and partnerships are pass-through entities.
Yes.
Do you guys remember the story I told you about this old lady who was
Mhm.
really upset with me?
Mm-hmm.
She invested in an S corporation, we could say a partnership, and the partnership made a lot of money, but instead of distributing money to the partners, it used it to pay down debt for the partnership. So she handed me a K1 for 50 grand in income.
Just when the partnership.
And when I plugged it into her tax return, she owed 20 grand in taxes and she was all pissed off. Do you remember this story or not?
Yeah.
Yeah.
And I had this, she didn't come back next year because she thought I did her taxes wrong. Okay, this is a real life story. She didn't understand the same thing that the two of you don't understand. Maybe all of you don't understand. The taxable event is when the partnership earns the income. You're taxed on your distributive share of profits or get a deduction from your distributive share of losses, regardless of whether anything has been distributed to you or not. That is the big difference. Write this down in your notes. That is the big difference between C corps and pass-through entities. Not just partnerships, but S corps work the same way. Okay? And it was kind of a hardship for this lady. I understand why she was upset, because this corporation made 50 grand and didn't give her any cash to pay the tax on the $50,000 profit. She had to come dig it out of her own pocket. So obviously there was some failure of management to inform the taxpayer what the consequences would be. Okay? Any questions on that? Boy, if you guys don't understand that, you could end up failing this course, so please understand that. Now, does that mean that all distributions of a partnership are always tax-free?
No.
No. What's the main exception?
That goes past basis.
Distributions, cash distributions, not property. Cash distributions in excess of basis. Okay? All right. All right, the next true false question, this will be a good follow-up. The next true false question is yours. I think you'll find this one rather easy. No, you.
Me?
If cash distributions exceed the partner's basis in his or her partnership interest, the partner must recognize gain on the distribution for the partnership. That's what we just said. That's the big exception, okay? Generally speaking, distributions just reduce your basis in your, as long as you have sufficient basis to absorb the distribution itself is not a taxable event at all.
Unless it's more.
It just reduces your basis. Okay? All right. All right. True or false? The check the box regulations allow a limited liability company, or LLC, the freedom to choose the type of entity it will be characterized for family income tax purposes. This is, it's his question. Yes, for you.
Can you repeat it again?
Yes. The check the box regulations allow an LLC, a limited liability company, the freedom to choose the type of entity it will be categorized for federal income tax purposes.
Yeah.
Absolutely, that's exactly what they're for. Okay? Which is why I went and made a big deal out of the RUPA definition versus the tax code definition. It was such an easy question. You want to take a stab at it a
Yes,
second?
give him
I love how they volunteer you. Hey, let's have some fun with this. I mean, it's like, you know, studying for these exams is not easy. All right, so if we can have fun with it, it makes it a little bit more tolerable, right? All right. True or false? The use of limited liability companies by taxpayers has exploded in recent decades. Over, say, corporations and S corps. Because LLCs offer the limited liability protection of a corporation with the tax attributes and benefits of a partnership. True or false? Sure. Okay. Can you explain to us, this is a more difficult question to follow up with, what are the tax benefits of a partnership that are deemed so valuable?
Well, you're only liable for the percentage of the amount of interest that you own.
All right, so there's a legal liability protection. You get the legal liability protection of a C corp without the disastrous tax consequences of a C corp. Are C corps a good way to own real estate? No. Why?
Because you have the limited liability over this.
Well, it's a double taxation regime,
Also,
right? Yeah. Plus, what if you have losses? Let's say that you buy a shopping center, real estate, and you're a landlord, and you put it in a C corp, and after your depreciation deductions and everything, you have a loss. What are you gonna do with that loss in a C corp? It's gonna sit there like a useless clump of nothing, right? Unless you have profits in that C corp that offset it against. It doesn't pass through anywhere. So that's what people are looking for, that pass-through technique. Not to mention the fact, here's another reason. S-corps and partnerships are a better vehicle to own real estate for one very important reason over S-corps. Does anybody know what it is?
Oh, the special allocation. Is it possible?
That's true, but that's not the one I was looking for. You're correct, there is no special allocations for it. That's absolutely correct. But it's not the one I was thinking of. Can you think of another one? Why are partnerships a better, especially if there's losses?
Liabilities? Like they can.
Can you spin that? Okay, what is it about
The
liabilities?
liabilities increases their basis so that they
Oh.
can take the losses.
What liabilities increase your basis for an S corp?
Just the one loan to shareholders.
Just the shareholders' loan. So if you borrow $1 million from Bank of America to buy this office building, and you don't get basis for it because you own it as an S corp, the loss pass-through could be limited because you won't have sufficient basis. partnerships, you get basis in your partnership interest for your share of partnership liabilities, all partnership liabilities, not just direct loans by the partners. In S Corps, you only get basis for direct loans by the S Corporation shareholders. Memorize that. If for no other reason for practice, whether it's on your test or not, I have to go back and see. All right. All right. I think I already did all the slides. Okay, this we already talked about again. Checkbox regulations allow an LLC to be taxed 1 of 4 ways: sole proprietorship, partnership, C Corp, S Corp. And there's the answer to that question. Use of LLCs exploded in recent decades because you get the limited liability protection of a C Corp, the tax benefits of a partnership. Now, going back to the question I asked the young lady over there in the corner about whether there is, the taxable event is the distribution to the partner, or whether it's automatically a taxable event just by virtue of closing the year end. This is the basic rules. Internal Revenue Code Section 702, the definition of a partner's distributive share. Those are magic terms of art of the tax code. A partner is taxed on his or her distributive share of partnership income or loss, regardless of whether the income is distributed to the partner or retained by the partnership. Does that mean the partnership pays a entity level tax?
No.
No. Who pays the tax on that income?
Taxpayer.
The partner.
Individual partner.
All right. All right, for the next one, back to doing math problems again. These are probably the most difficult problems of the test. How am I doing on time? Yeah, not too bad.